Rumours abound that Old Mutual could be selling its stake in Nedbank, and that Nedbank could see itself in foreign hands, either HSBC or Standard Chartered.
It's very good news for Nedbank shareholders, particularly given the fact that they've been very absent in the broader African community. So for them to grow and expand, they need somebody with an African presence. Unfortunately, of the two suitors that were here in the market, only one has got a huge African presence. And I think strategically for Nedbank, without influencing what's going on, there will be a lot of benefits and synergies with the one that's got a huge presence in Africa, because that's the growth of the future. We know that in terms of, you look at the GDP per capita, the potential for growth is exponential in those countries, given the base where they come from.
All right, Standard Chartered, I think, is the one you're referring to, which has a presence in 70 countries, and quite a few of them are in Africa. That's the one suitor. The other one is HSBC, has a presence in more countries. It's a bigger bank at 88, but seems to be concentrating its energies on Asia because it believes that's where the next growth is going to come from. Either way, how much attention would a foreign shareholder give to Nedbank?
Well, a lot of attention, because one of the biggest benefits is technology. Because you know that a bank is nothing but IT driven. You've got an amazing you're easy to bring efficiencies, to lower the cost of doing business, and to pass that benefit and be competitive both in the household as well as the corporate market. And HSBC, given the expertise, even Standard Chartered for that matter, will bring that. But more importantly also, transfer of skills, because you know that a lot of South Africans and some Africans will benefit in terms of being in a global bank and benefiting from transfer skills, and also working offshore, given the product base that these parties will bring to the table.
All right, let's talk about how attractive Nedbank is. Earlier, Andrew and I were talking about the fact that the results have come through for some South African banks, lots of impairments. Nedbank even had the additional exposure over the last 18 months of the Old Mutual shareholding, and the fact that Old Mutual had incurred some difficulties within the United States at the height of the recession.
Well, in fact, as we know, Nedbank had rushed into the retail sector because they lagged behind. If you compare Standard Bank and Absa, who really were in particularly the black market, they came in to come and tap in and compete in that space. But unfortunately, timing was quite wrong, because the National Consumer Credit Act came in, and in that process, they went into an area that they hadn't had experience during hard time. The two competitors had been there in the 1999 high interest rate environment and had survived it. So it makes sense for them that they've learned lessons, but I think any of the two suitors will bring more value, because the lessons learned during the crisis that has just gone by will be passed on. However, I think more challenging, I think for the new bank is really how will they deal with the price tag that's going to be put on the table, because I think we know that there's still a lot of value in South African banks, and therefore the price tag, particularly from Old Mutual, might not be that attractive.
Let's get your viewpoint on this one.
Yeah, I think it would be interesting, because when a foreign bank comes in and they pay this hefty price in a market that's been accused of being relatively expensive, what is the incentive for them to actually push competition into the market? And I think that will be one of the concerns, because what you would want to see from another participant is competition, lower prices for consumers, and whether that will come through with the hefty price tag is to be debated.
Let's just look at an event that did happen. 2005, Barclays taking over Absa. They paid about 28 billion rands. It was good for Absa, and it was good for the South African economy. What would be fair value in this instance?
Sure, that's to be debated. I suppose it's really what Old Mutual wants to offload it for, and I think that's what you're seeing at the moment, is they're really playing two suitors against each other to increase interest and to increase price. I think what's interesting is, as was mentioned, is you have to look at what the benefits are that get brought to the table as a result of the transaction, but also what are the risks associated with it. You know, the South African banking sector was relatively insulated during the crisis that we saw, and one has to look at that and see, maybe in the insurance context, Old Mutual, for example, imported risks from its operations offshore, and I think that the regulators will look at that quite closely.
Okay, what we are going to benefit as consumers, here's the issue. we often lament the fact that transaction costs or some transaction fees in South Africa are particularly high. And what should happen in an ideal world is that a foreign entity taking over shareholding should reduce those fees because their balance sheet is in foreign currency. So they shouldn't need to be making money through high transaction fees. It hasn't really happened in South Africa. And there's a sense that foreign owners quite like this oligarchy of high fees.
Sure. I mean, it's wonderful if there's a oligopoly, as the case in South Africa, because there are about these 4 or 5 banks. It means that there's some fat that if a buyer, you can cream out. But the reality is that, you know, with the foreigners, for example, for corporates, it means that if I'm Tiger Brands, for example, I'll have a much more, and a bank within that bank, I'll have at least a branch if Standard Chartered comes in Lagos or in Nairobi. But more importantly, I think for consumers, is that we've seen with Barclays that a lot of those that bank with ABSA, they've got mobility because they can tap in wherever they go in the Barclays network overseas. So there's quite a lot of benefit, but not in terms of cost. The cost will only come in, will only come down when the regulators start nailing and getting to the depth of the problem. Because in Africa, we know that the costs that are charged by banks are still very, very high. So I'm looking forward to Ms. Marcus really looking deeply into the cost structure, including the competition tribunal or the commission authorities as a whole.
Okay, Lumkile has mentioned 2 issues, cost structure and opportunity. And if you look at the Barclays ABSA transaction, for instance, some people would argue that it didn't instantaneously open the door for ABSA into the rest of Africa. They've struggled in that regard.
Well, I suppose there have even been accusations that it slowed them down in terms of Barclays as a parent company, their ambitions up in Africa. It would also be interesting to see if one of the suitors takes over and their focus is strategically in Asia, how that influences Nedbank's move up into Africa. Quite correctly, is they've lagged behind the curve, and it is a massive growth market, and you see Standard Bank taking full advantage of banks like Nedbank not being involved. So I think it would depend on strategy of the parent company ultimately.
Okay, Jill Marx's name has been mentioned here, and this takes us into this perennial question of economic nationalism, where the Reserve Bank, in trying to promote FDI, should also protect national assets. And with 5 big banks, this is a national asset, and there are sections of the community saying do not sell it off to foreigners.
Well, for us, post-World Cup, any foreign direct investor in South Africa is a positive sign. We need that affirmation because we believe that with the financial sector coming in, hopefully the fixed sector will come in. That's the real sector where we'll see some of the guys coming in to compete, because we know that in the broader industry, the study released by the World Bank showed very clearly last week on the South African Climate Survey that there's concentration in many industries, whether it's cement, whether it's steel, that, you know, the positiveness that comes with the bank will bring in other guys into the party. So I think if I'm Jill Marcus, I'm Reserve Bank, I will continue to allow them to come in. I don't want them to buy 51%. I want them to have a controlling majority, maybe 25, 26% as a shareholder of reference, so that, you know, the broad base is still South African, but at least there's the shareholder of reference international to bring the additional value that we talk about to the banking sector in South Africa.
Andrew, what do you think Jill Marcus, as governor of the South African Reserve Bank, and her team need to mull over? Because there is a lot of pressure to keep South African champions in the hands of South Africans. We saw some of this play itself out with the Barty MTN deal, for instance.
Yeah. I'd wholeheartedly agree in that you want to protect assets and retain control, but at the same time, in an increasingly global environment, as you can't afford to be insular and you can't afford to not be involved in this global world. You know, one of South Africa's positioning advantages is that we are, to an extent, a gateway into Africa, and so you need to be connected to it. And if this is a mechanism to do it, so be it, but not from the perspective of you give away control 100% or 51%, as you say.
All right, as somebody suggested earlier on, Nedbank is playing the 2 suitors off against each other, so it's still a while to go before this is a foregone conclusion. And that raises the question, is it possible that a local South African bank would make a bid for Nedbank?
No, I don't think regulators allow it. We already have got about 5 banks here. We don't want too much one bank that's having a stronger share of the market. So in terms of competition law, I don't think that they'll succeed. I don't see them succeeding at all. Unless, in fact, it's one of, if it's the 5th player, which is smaller, which is not far away, just behind you, who are seated, maybe they might have a chance. But I don't see the authorities allowing it.
He's just raised this issue of competition. The Competition Commission wouldn't allow it. But 5 big banks, many people say that's an oligopoly in itself. And with the entry of the ICBCs into Standard Bank, for instance, Barclays into ABSA, we haven't seen competition really and truly emerge from all of this.
But I think to a certain extent that's self-explanatory, as it's highly unlikely that that change would come from within the industry, as they're in a comfortable position. Charges are high, yes, but they're allowed to get away with it. And you know, ultimately that change is going to have to, as Lumkile said, is going to have to come from the regulator. It's unlikely that they're going to self-manage themselves down. So I don't see that changing until there's regulatory pressure.
Okay, what we're going to do to try to instill a level of regulatory pressure to open up the banking sector?
Well, quite importantly, there's a whole debate going on within the state, particularly within the left of the ruling party, where there's a talk about another bank that the state will start. It's not a good idea. It's throwing good money to a bad business. But this is South Africa. It's full of surprises. That's why we love this country.
Andrew, do you want to add to that?
I don't think I should.